So chapters 4 is completing the accounting cycle. In there, I'm going to introduce two different forms of financial statements, as well as using an accountant's worksheet in order to complete the adjusting entries that we talked about in Chapter 3. The reason 4 and 5 are combined, Chapters 5 is accounting for merchandising business. There are 3 types of businesses that, commercial type businesses. There's either service industry. This includes hotels and cruise ships and airlines and lawyers and doctors and accountants. I mean, they sell their service. And then there's merchandising business. Merchandising business can be either wholesalers. They buy a finished good from a manufacturer and then resell it to their customers. Or they can be manufacturers, and they build these finished goods that they sell sometimes directly to the public, in the case of Apple. I mean, God bless you. Apple sells straight from their plants in China. You can get it shipped straight to your door. So they sell directly to customers as the manufacturer. But they also sell to wholesalers. So if you go into a Walmart or a Best Buy or a Office Depot and buy an iPhone or an iPad, they have sold it as a wholesaler to those individuals. All right? So the 2 statements that we're going to talk about today are a classified balance sheet, which your book calls the report form, but it's a classified balance sheet. And that's chapter 4. And then a multi-step income statement. So thus far in chapters 1 and 2 and on the first midterm, we did a simple form balance sheet, unclassified. All of the assets were listed in one group. All of the liabilities and stockholders' equity were listed in another group. All right? There was no order to any of those 2 sides. The single-step income statement, it just had revenues minus expenses, all right, to come up with net income. Well, the classified balance sheet is going to break down those 2, the accounting equation, into groupings, all right? The groupings, in general, for the balance sheet, under assets, are current assets, property, plant, and equipment, intangible assets, for purposes of this class, that'd be enough. If you go on to intermediate accounting, there's also investments, and then there's an other category for stuff that doesn't fit in these 3, all right? Under liabilities, so assets equals liabilities, there's current liabilities, and long-term liabilities. So there's two possible categories under liabilities. And then under stockholders' equity, there is contributed capital and retained earnings. So two sections each on the liabilities and stockholders' equity side in four possible sections, well, three possible sections is what we'll talk about in here, on the asset side. Okay? So what are current assets or current liabilities? Well, what makes them current is they're either going to be used in the current year or an operating cycle. So both of these are current year i.e. the next 12 months, or an operating cycle. Whichever is longer. So what's an operating cycle? An operating cycle is the time it takes from the moment you start spending money, start spending cash, in order to generate the revenues that you survive on, until you get cash back from your customers. All right? So that's an operating cycle. Cash out to cash back in. Now, most companies, that is way, way, way shorter than 1 year. As a matter of fact, I had discussions with the other accounting faculty at lunch for weeks on end until somebody came up with a company, an industry, that has an operating cycle longer than 12 months. It was sheer brilliance, because none of the rest of us could name one. And what she came up with is if the only thing your company produces is 12-year-old scotch, if that's the only thing you do is produce 12-year-old scotch, then you've got a 12-year operating cycle. Everybody else, it's 12 months. All right? And that was the only example that anybody could come up with. Right? Because everybody, by the time you start spending cash by paying your employees, and then you buy some things, whether they're finished goods or raw materials, and then you sell those things in the case of a merchandising company, and then you give your customers time to pay you. Most of it is in the 45 to 60 day range. Dell computers, has anybody in here got a Dell computer? I see a lot of Apples. Dell computer actually has a negative operating cycle. I read a scholarly article on it one time, an academic article. They get money from their customers before they spend a dime. Because if you've ever ordered a Dell online or over the phone, you had to pay for it. And at that point, they gave you a shipping schedule as to when you would receive your new Dell desktop or laptop. Right? So once you paid for that Dell computer, they've got their cash in hand. And at that point, they go out and they issue a purchase order to all of the suppliers. All of the chips and the hard drives and the power supplies and the motherboards and the cases and the monitors and everything that is needed in order for you, for them to build your computer. And they pay those suppliers on a 15-day cycle. So a supplier pulls out of, they've actually got factories with suppliers ringing around the production floor. So when you order a laptop, some supplier, Seagate, for instance, makers of hard drives, goes over there and pulls the hard drive that you want off the shelf, puts it in a basket, and sends it to the production floor. And Seagate gets paid by Dell 15 days later. So they have a negative 15-day operating cycle because Dell's already been paid. That's why now Dell is slowly responding to market demands and is starting to build computers, to use a real estate building analogy, on spec. So you can go to Office Depot and buy a Dell. So they built those, sold them to Office Depot, so it's starting to eat into their negative operating cycle. But they had a negative operating cycle for many, many years. Okay? So what we're going to do is I'm going to do 2 examples on the board of a classified balance sheet and then one of a multi-step income statement. And then I'm going to lower the screen, turn the projector on, and I'm going to show you an accountant's worksheet and then how to complete the multi-step income statement, the statement of retained earnings, and the classified balance sheet on an Excel spreadsheet, which is your Excel project that I will assign this coming week. That'll be due the week after we get back from spring break, so almost the end of October. You'll have almost a month to complete it. All right? Okay, so current assets are everything that is cash, what you're going to turn into cash, what you're going to sell, and what you're going to use up in the next 12 months. All right? So it's cash, what you're going to turn into cash, that's accounts receivable and notes receivable, what you're going to sell, inventory, and what you're going to use up. That's prepaid rent, prepaid insurance, supplies, things like that. Current liabilities is everything that you have due and payable in the next 12 months. So that's your accounts payable, your salaries and wages payable, your interest payable, your taxes payable, probably your unearned revenues or customer deposits. All right? Okay? Long-term debt is anything that's due and payable beyond those 12 months. So bonds, mortgages, long-term loans, term loans. Okay? So that's beyond the 12-month. Property, plant, and equipment are tangible, fixed assets that are long-term, that you're going to use for more than the next 12 months. Computers, buildings, desks and chairs, delivery trucks, airliners, ships, taxis, fleet cars, whatever it is you own in order to conduct your business. Intangible assets are assets that a business owns that do not have a physical substance. You can't touch them. They're patents, copyrights, trademarks. Everybody know what a trademark is? Everybody know what's this? McDonald's. It's not a banana. I'm not the greatest drawer in the world. That's supposed to be the Nike swoosh. Here. That. Wearing the shoes. Okay, so those are trademarks. They have value. Companies spend money to register them and defend them, and so they're assets that they own. Okay? Patents. You're constantly patenting new technology, new ideas, new business practices. They have value. You buy patents from other inventors. And that's an asset that you use in order to conduct your business. All right? So is everybody clear on what? Oh, I haven't finished. Stockholders' equity. Contributed capital is what the stockholders have given to the company, what they have contributed in the form of capital. So that's common stock and an account called paid-in capital in excess of par. Most states, stocks are issued on a state. Corporations are incorporated based upon state laws. Most states require that a stock has a par value. It's printed on the certificate. If you ever get a stock certificate, it'll say $1 par, or $100 par, or 1 penny par. When you sell that stock, you will, in many states, you're not allowed legally to sell the stock for less than par. Not all states, but many. So that's why par value is normally very small. You'll commonly see 1 penny par, because they can't physically sell the stock for less than a penny. All right? So anything that they actually sell the stock for during an initial public offering or a new offering that is in excess of that par value goes into additional paid-in capital in excess of par. Okay? And you'll see that next week when we do the review for the second midterm, because it has both capital stock, common stock, and paid-in capital in excess. Okay? So that's contributed capital, and you already know what retained earnings is. That's the profits, the net income generated since the moment the corporation started that were not distributed back to the shareholders in the form of dividends. All right? Okay. Now that we have a general idea as to what we're talking about, let's do some problems. We're going to start with problem 4-2A. So 4-2A, it starts at the bottom of page 200 and continues up on page 201. So problem 4-2A on page 200 and 201. All right, on this one, Finders Investigative Services is an investigative service firm that is owned and operated by Stacy Tanner. On June 30th, 2016, the end of the fiscal year, the accountant for Finders prepared an end-of-period spreadsheet, part of which is shown at the top of page 201. So it's asking you to prepare an income statement, a retained earnings statement, and a balance sheet. In the interest of time, I'm just going to do the balance sheet, because I want to go on to Chapter 5 and do a multi-step income statement. This problem had a single-step income statement. All right? So I will show you when I get to retained earnings what the new retained earnings balance, because the one that is listed here in this end of period spreadsheet under the adjusted trial balance is the prior retained earnings. So we'll have a new one when I get to it. All right, so 3-line header as always. Finders Investigative services. It's the balance sheet. And it is June 30, 2016. Remember, the balance sheet does not measure activity. It is not for the year ended. It is just the date. All right? Assets. Because we're doing a classified, we start with current assets. Now, current assets, as I said, are cash, what you're going to turn into cash, what you're going to sell, and what you're going to use up in the next 12 months. So cash, what you're going to turn into cash, what you're going to sell, and what you're going to use up in the next 12 months. Now, this is the only section in this classified balance sheet that has a specified order in which the accounts have to be listed. All right? There's an order to it. And they're listed in order of liquidity. So what is liquidity? It's not trudging across campus on Monday getting wet. That's different. Yes, it's how close to cash is it. Liquidity, the more liquid the asset, the faster you can turn it into cash, into money. All right? So cash is always first because cash is already cash. And on our adjusted trial balance, this Finder's Investigative Services had $28,000 worth of cash. All right? Now, the next thing in order of liquidity is what they're going to turn into cash. And what account do you turn into cash? Quickly. The amount your customers owe you. Accounts receivable. And they had $69,600 worth of money owed to them by their customers. Accounts receivable. They're an investigative service, so they are the first type of business that I was talking about. The business that sells its services. So they don't have anything to sell. So there's no inventory. So what are they going to use up? Well, they're going to use up their supplies. They have $4,600 of supplies. This is after adjustments. So they've already gone in and counted everything they've got in their supplies cabinet and determined how much they used in supplies. And then the last thing they're going to use up in the next year is prepaid insurance. And that's $2,500. If you add all that up, you get $104,700 as total current assets. The next section is property, plant, and equipment. So this is all the long-term, tangible assets that this investigative services own. And they only have one. They've got a building. That they built or bought or did something with, costing them $439,500. $439,500 worth of building. From that, you're going to subtract less accumulated depreciation. On the building. And that's $44,200. If you subtract that contra asset account, that negative asset, from the building, because you'll see on the adjusted trial balance, that had a credit balance, where assets normally have a debit balance. You get a net book value of the building and total property, plant, and equipment, God bless you, of $395,300. And that is total property, plant, and equipment. If you add the $395,300 to the $104,700 of current assets, you get $500,000 even. So the current assets of $104,700 plus the $395,300. The total of those two sections in the classified balance sheet is $500,000, which is total assets. Okay? They didn't have any intangible assets. They didn't have any patents or trademarks or copyrights or anything like that. Liabilities. Current liabilities. This is everything that they have due and payable in the next 12 months. So they have some accounts payable. $11,700. And they have some salaries payable. $3,000. And they've got some unearned rent. $2,000. Add all that up, that totals $16,700, and that's total liabilities. And that's only because they have no long-term debt. So however they got a hold of that $439,500 building, they didn't borrow any money on it. Not very realistic, but whatever. It's a problem. All right, so everything they had was current. On your midterm that we'll review next week, I'll have long-term liabilities in there, so you'll see that. Then, the last section, stockholders' equity. Stockholders' equity is broken into contributed capital, and they only have one, common stock, of 80,000, and retained earnings. And the ending retained earnings balance is 403,000. Add those two together, you get 483,300 as total stockholders' equity. Add that to the 16,700 worth of total current and liabilities, and you get the same $500,000 in total liabilities and stockholders' equity. That's your classified balance sheet. Everybody good on this one? Can I erase the asset side? I know you guys, some of you are still doing the other side, but I'll get this side cleared up so I can start on the next problem. So this one is problem 5-5A on page 261. (5-5A) on page 261. On this one, the following selected accounts and their current balances appear in the ledger of Claremont for the fiscal year ended May 31st, 2016. So there's a list of all this, and these are the adjusted balances. And the problem is asking you in instruction number 1 to prepare a multi-step income statement. And this is a merchandising company. You can tell that it's a merchandising wholesaler or store because they have a merchandise inventory. If this was a manufacturer, they would have had a raw materials inventory, they would have had a work-in-process inventory, and they would have had a finished goods inventory, which would have told you that it was a manufacturer. All right? They also, over here on the right column, they have a cost of merchandise sold. So as they sell the inventory, they are expensing how much they paid for that item. All right? To properly match the revenue and expense. So a multi-step income statement breaks that very simple single-step income statement that we've been dealing with thus far into groups to provide the readers of your financial statement with a little bit easier way of translating and analyzing your business, your operations. All right? So for a merchandising, there are 4 subtotals, 4 new calculations that we're going to add into the single step. It used to be total revenues minus total expenses equaled net income. Net income was the only calculation. Right? Hence, single step. So what we're going to add is we're going to add a gross profit. So I'm going to forego the 3-line header because this is going to take up most of the board. So it's Claremont Company. This is the income statement. Just like the balance sheet, it's not called a classified balance sheet. It's just called a balance sheet. And this is just an income statement. And it is for the year ended May 31st, 2016. So we're going to start with sales, which is $11,343,000. From sales, we're going to list the cost of merchandise sold. Which was $7,850,000. Which brings us to the first of our multi-step. Subtracting total revenues, total sales of all the products that they sell, minus what it cost them to buy those products from wholesalers or manufacturers, is gross profit. So that's the first of the steps. And in this case, that's $3,493,000. That's what they're making on the direct products that they buy and sell. From that, we're going to deduct operating expenses. What expenses do we directly incur on our day in, day out operations? And this is going to be broken down into 2 further subcategories. Selling expense what expenses are directly related to the selling of our products? Well, the sales salaries. The people actually out there meeting with the customers, either on the floor or driving around the countryside or answering the phone. The people we pay directly to sell our products. So sales salaries. $916,000. Advertising. is a selling expense. These are the TV commercials, the radio commercials, the ads that we pop up on Facebook, everything, newspaper, magazines. $550,000. The depreciation expense on the store equipment. Store equipment, which was $140,000. And then lastly, miscellaneous selling. So everything else directly associated with selling our goods and services. That's $161,644,000 worth of total selling expenses. Administrative expenses. We've got some office salaries. $650,000. We have rent on those offices. $94,000. We have depreciation expense on the office equipment. $50,000. We have some insurance. Insuring all that office equipment. And then we have some office supplies. $28,100. Oh, wasn't finished. Then we got some miscellaneous. $14,500. Add all that up, and you get total $884,600 as total administrative expenses. Add that $884,600 to the $1,644,000 of total selling expenses, and you get total operating expenses of $2,528,600. $2,528,600. Those are all of the day in and day out expenses that we incur in order to sell the merchandise that we sell. and to operate the business on a daily basis. If we subtract the total operating expenses from the gross profit, that first subtotal that we calculated in this multi-step, you get the second subtotal, which is income from operations. And income from operations is $964,400. To income from operations, you're going to either add or subtract other revenues and expenses. These are items that are outside of the day in and day out. These are items that some companies have, but some companies may not have. So things like if we were renting a piece of a building to a subtenant, then that would be rental revenue. It's not our core business. It's not what we get up to do in the morning. It's just ancillary. It's extra. So the only one that this particular company has is interest expense. And they have $21,000 in interest expense from items that they borrowed. Which brings us to $943,400, and I'm going to write it in. The fourth subtotal is income before taxes. Now, this particular example doesn't have an income tax expense, but almost every company has them. All right? And then you would subtract an income tax expense. I'll just put that in here, even though they don't have it. To come up with your fourth and final subtotal, net income. Income tax expense was 0. So net income is the same, $943,400. Yes, yeah. All right? That's the multi-step income statement. So that's total sales minus cost of goods sold, which equals then gross profit, the first of the four subtotals in a multi-step income statement. From that, you subtract operating expenses, both selling and administrative expenses. That gives you income from operations. Then add or subtract any other revenues or expenses. That gives you income before taxes. Subtract out income tax expense, and you get net income. So those are the four steps. Gross profit, income from operations, income before taxes, and net income. So by dividing that up, that provides the readers of your financial statement with some additional insight into your company. All right? All right, I got 20 minutes left, so I'm going to start a example of an accountant's spreadsheet to show you how to flow from an accountant's spreadsheet to a set of financial statements. All right? And I'm also going to do this, I'll record me doing this online, so I'm going to post under chapters 4 and 5 both the video and this spreadsheet along with another video that I'll record here in the next few days of me completing this spreadsheet, all right? Completing it to a multi-step income statement, a statement of retained earnings, and a balance sheet, because I'm fast with Excel, but I don't think I'll get it all done in 20 minutes. So, or at least not in a way that you will be able to follow. Okay. All right. So what I'm going to do is I'm going to set this down over here so that camera stays on the screen. Oh. That's a very flat rig site. And then I'm going to turn this one on. So that I can capture my voice. All right. So as soon as that comes up, it appears magically. All right. This is an end-of-period spreadsheet, a worksheet, otherwise known as an accountant's worksheet. It has the unadjusted trial balance, and this is problem 4-3A on page It starts on page 201, and then it continues on the top of page 202. So 201 to 202. And in that, it says the unadjusted trial balance of Epicenter Laundry on June 30th, 2016, the end of the fiscal year, is as follows. And it's got this $475,000 worth of ledger balances that came straight from the posting of transactions on a daily basis in the journal. Okay? Unadjusted. And then at the top of page 202, they give you 4 adjusting entries, similar to what we were talking about in Chapter 3. So those entries are laundry supplies on hand on June 31st are $3,600. Well, you can see here in laundry supplies, there's a balance of $21,500. We need to make an adjustment, that's the balance sheet account, we need to make an adjustment to that so that over here in our adjusted trial balance, in this cell here, we have a balance of $3,900. Okay? I'm sorry. Wrong one. This one. Let's try the third time. That one, $3,600. So we need to go from the $21,500 down to $3,600. So if we're going to go from a debit balance and reduce a debit balance, an asset, we're going to do a credit. So the A entry is going to be a credit to the laundry supplies account of $17,900. That reduces it from the $21,500 down to the $3,600. And you can do that in the accountant's spreadsheet by taking the old balance and simply subtracting the new balance. No. Yeah, except that I have. All right? You can do that right on the spreadsheet. Okay? What's the other side of it? That's the balance sheet account. Laundry supplies. So what would make sense for the other side of it? The income statement account. Something, something expense, right? Because you're using up these laundry supplies. Well, if you look down here, there's no laundry supplies expense in the original unadjusted trial balance. So you need to add it. You need to add a laundry supplies expense, and that will be the other side of the A entry, $17,900. Okay? The second adjustment, B, insurance premiums expired during the year are $5,700. You go back up to the top, and you see that we have prepaid insurance totaling $9,600. Well, it doesn't tell you how much is still unexpired. It tells you that $5,700 of that amount has expired during the year. So that's the balance sheet account. Both of these were deferred expenses, one of the four types that we talked about in Chapter 3. So what's the income statement account? Something expense, right? So what is this? It's insurance. Also, oops, that one. Insurance expense. Okay? Depreciation of laundry equipment during the year is $6,500. Well, since I'm here, the income statement account, the debit, is to depreciation expense, another new account that needed to be added. And then the credit is to this contra asset account, accumulated depreciation. That's the balance sheet account. And then the very last adjustment was wages accrued but not paid on June 30th amounted to $1,100. So we have a wage expense down here. So that's the debit, wage expense. That's the income statement account. And we also have up here a wages payable, even though it didn't have a balance in it. That account existed in our trial balance. No, it didn't. We needed to add that one. So wages payable needs to be added underneath accounts payable. Add all those columns up, and we have total adjustments of $31,200 and total credits of $31,200. So we started with an unadjusted trial balance that balanced. Both debits equal the credits. We've made adjustments where the debits equal the credits. So in theory, the adjusted trial balance should. So what are the adjusted trial balance? Well, it's quite simple. You take any debit balance from the unadjusted trial balance, you add any debit adjustments, and you subtract any credit adjustments. So it's column B plus E minus G. So that's all of this plus dividends plus all of the expenses. And that's a total debit column of $482,600. Anything with a credit balance off the unadjusted trial balance, you're going to take the credit balance and you're going to subtract any debit adjustments and then add any credit adjustments. So that's the contra asset account plus the liabilities, the common stock, the retained earnings, and the revenues are all the debit balances. All the credit balances, I'm sorry. And if you add up all the credits, lo and behold, the adjusted trial balance balances $482,600. The last thing to help you organize your financial statements, the accountant's worksheet commonly has a column for the income statement accounts, of which starts with the revenues. So the income statement accounts start here with the credit on the total laundry revenue, and then all of the expenses. The wages, the rent, the utilities, the laundry, all the expenses. If you add up all of the debits and all of the credits, you will see it no longer balances. Because we're only doing the income statement accounts. So what's the difference between the two columns? What's total revenues minus all the expenses? Net income. So under the debit, what is needed to balance those two accounts is net income of $10,700. And then all of the balance sheet accounts are all of the assets, the contra asset, the liabilities, the common stock, the retained earnings beginning balance, and the dividends. So even though the dividends are a statement of retained earnings account, it eventually flows into the calculation of ending retained earnings, which is a balance sheet account. If you add up all that, once again, the columns don't total. There's $261,100 in debits and $250,400 in credits. The difference is, once again, the net income. Because net income gets added to beginning retained earnings, then you subtract the dividends to come up with ending retained earnings. And once you do that, everything balances once again. All right? A very useful tool, the accountant's worksheet. From here, and I've got just enough time probably to do the income statement, is I can do an income statement. All right? This is for Epicenter Laundry. It's the income statement. And it is for the period ending, the year ended July 30, 2016. It only has one revenue account, and that is this laundry revenue. And that totaled, under the income statement here, $232,200. So you see, I'm not retyping anything when I do the financial statements. I'm just putting in a formula. I'm putting in for the name, the laundry revenue, for the account name, I'm just going over to the far column A on the far left of the accountant's worksheet and selecting the account. And then I'm doing the same thing for the balance. From this, you're going to subtract expenses. Operating expenses. So that starts with wage expense, and the total for that is $126,300. And now that I've got that there, I can drag it down. See how the cursor changes from a big plus to a little one? This is called fill. And I have 1, 2, 3, 4, 5, 6, 7. 1, 2, 3, 4, 5, 6, 7. There's all my expenses. Magic, is it? I then subtotal this up, and that will be my total operating expenses. And then we'll get income from operations of $10,700, which you already knew that that's what the number was going to be, because that's the number that you needed in order to balance out the debits and the credits on the income statement columns. Okay? And then I can put a top and bottom border on that to make it pretty. I can put a bottom border on this. Actually, I want a bottom border on both of those. And that's your income statement. And what I'll do is I'll do the statement of retained earnings and the balance sheet, the classified balance sheet, online. I'll record it with just the screenshot. That'll help augment this demonstration. Okay? So what I'm doing here, what I'm recording and posting online is your Excel spreadsheet project that is due. So what you're going to be doing, and I'm going to post this, you're going to be doing 4-4B on page 207. And I'm going to include a PDF of that out of the page, out of the textbook. So I will include that when I post that Excel assignment. So that's what you're to do, and I'll figure out the due date. It'll be like a Friday night the week after we get back from spring break. So like the 21st of October, I think, is the date. So you've got almost a month to do that. Yes, sir?
Is it as 4B?
4B. 4-4B on page 207. So it's a recessive interiors. The unadjusted trial balance is listed there, and it has 5 year-end adjustments. And then you're to do a multi-step income statement, a retained earnings statement, and a classified balance sheet. And I'm going to show you a recording step by step going through this problem here doing the same. Okay? All right. Have a good weekend. Hold on one second. Let me turn this off.